Welcome, everybody, to the HOTMA Income and Assets Training Series. HOTMA is the Housing Opportunity Through Modernization Act of 2016. This law made several changes to HUD's rental assistance programs, including changes to rules for income determination and program eligibility for the Housing Choice Voucher and public housing programs, among other HUD-assisted programs. This series is meant to support public housing agencies in implementing rule changes related to determining income and assets for public housing residents and Housing Choice Voucher Program participants. This is the third training in the series and focuses on the implementation of HOTMA Sections 102 and 104, which are primarily related to income calculations and reviews, including assets and the asset limitation. My name is Farah Fasseh, and I'm part of the team of HUD Technical Assistance Providers from NALCAP, the National Association of Latino Community Asset Builders. We've been working with HUD to create this training series. HUD staff will be available for questions at the end of the training.
Hi, my name is Philip Stump Kennedy, and I'm also part of the NALCAP team. Before getting started, we wanted to make sure that you are able to ask questions and raise any tech concerns. Please note that the webinar is being recorded, and the recording will be available through HUD Exchange.
There are 3 trainings in this series related to new rules required by HOTMA. There are also related fact sheets and products available on the HUD Exchange. If you missed the first training on Section 103, over income public housing families, or the second training, which was on income and assets, or would like to access the related resources, you can go to the HUD Exchange HOTMA landing page. Recordings of the trainings and related resources are available there.
This training will cover the following subjects: net family assets, inclusions and exclusions, the asset limitation, calculation of income, authorization to release information, safe harbor income verifications, de minimis errors, and interim reexaminations.
Before getting into the details, let's review some key points that we'll cover today. The definition of assets has changed and is now defined as all family assets with enumerated exclusions. HOTMA introduces a new asset limitation. Families cannot receive benefits if they have over $100,000 in total assets or ownership in real property where the family could live. Residents may self-certify their assets if total net family assets are under $50,000. New rules govern how income is calculated. PHAs may use other means-tested federal public assistance programs' income determinations. PHAs are not required to use the Enterprise Income Verification's income reports at interim reexaminations. The new HUD 9886 form will only need to be signed one time. PHAs will not be considered out of compliance solely due to de minimis errors in calculating family income, but must take corrective action if the family was overcharged. And HOTMA places restrictions on when an interim reexamination may be completed.
We'll start by talking about net family assets, the net family assets definition. The new rule changes the definition of net family assets to include more exclusions than the previous definition. These excluded items would not be taken into consideration when determining if the value of the family's total assets exceeds $100,000 as adjusted. Net family assets includes the cash value of all assets, except those specifically excluded. The value under these regulations is the net cash value after deducting reasonable costs that would be incurred in disposing of some assets. For example, disposing of real property may include repayment of a mortgage or other monetary liens on the property. The assets exclusions, and limitation on assets resource sheet, which is part of this training series, includes the full list of exclusions.
Necessary items of personal property are excluded from any calculations of personal property value. Items of personal property not counted as necessary items must have a combined total value of $50,000 or less, as adjusted by CPIW annually, for the PHA to exclude the property value from the family's assets. Some examples of necessary items may be medical devices or cars used for commuting. However, determining what is a necessary item for personal property is a highly fact-specific determination. Therefore, creating a list in the regulation would be inappropriate. HUD will be creating additional guidance to assist PHAs. Non-necessary items of personal property are excluded from net family assets when they have a combined total value that does not exceed $50,000 as adjusted. 5.618B1 allows families to self-certify net family assets below $50,000.
The following are asset exclusions for certain types of accounts and real property. The value of real property that the family does not have the effective legal authority to sell in the jurisdiction in which the property is located. Interest in Indian trust lands. Any account under an IRS recognized retirement plan, including IRAs, employer retirement plans, and retirement plans for self-employed individuals. The values of any Coverdell education savings accounts, Internal Revenue Code Section 530, any qualified tuition program, Section 529, any Achieving a Better Life Experience or ABLE account, Section 529A, and any baby bond account created, authorized, or funded by any federal, state, or local government. And finally, family self-sufficiency accounts.
The following are asset exclusions for cash and trust funds. Federal tax refunds or refundable tax credits for a period of 12 months after receipt by the family. Any amounts recovered in a civil action or settlement based on a claim of malpractice, negligence, or other breach of duty owed to a family member for an incident resulting in a disability. A trust fund that is not revocable by or under the control of any members of the family or household is not a family asset. If the trust fund later becomes revocable or under the control of a family member, it is no longer excluded.
In the case of negative equity alone does not justify excluding the property or other investments from family assets. Negative equity does not prohibit the owner from selling the property or other investment.
For sales of assets where the family received less than the fair market value, the PHA must take into account the value in excess of what was received in compensation for the business or family assets disposed of during the 2 years preceding the application or reexamination. This includes a disposition in trust, but not foreclosure or bankruptcy sales. For dispositions through a separation or a divorce settlement, the disposition will not be considered to be for less than fair market value if the family member receives consideration that is not measurable in dollar terms.
Self-certification of net family assets. The PHA is required to obtain documentation from the family regarding some assets. For net family assets under $50,000 as adjusted, the PHA may accept self-certification from the family. Certification must include any expected income from the assets, actual returns. No further documentation is required by the PHA for the net family asset restriction. For property ownership, the PHA may accept self-certification that the family does not have any present ownership interest in any real property. The statutory self-certification only asks about ownership and does not address the other elements of the restriction: legal right to reside in, effective legal authority to sell. PHAs can use a form with the statutory self-certification question and then follow-up questions related to the other elements.
We'll now discuss the new asset limitations. HOTMA introduces new restrictions on families receiving benefits from public housing or the Housing Choice Voucher Program based on the family's assets. Families cannot receive benefits if they have over $100,000 in total net family assets or ownership in real property where the family could live. Both limitations have many exceptions. The asset limitation will be adjusted by CPIW starting in 2025.
The PHA cannot waive the asset requirements, but can delay starting eviction or termination of assistance proceedings for up to 6 months. The PHA may also set a non-enforcement policy allowing the family to come into compliance within a certain time frame, again up to 6 months. Adopting a non-enforcement policy means that the PHA may allow families to come into compliance with the asset limitation within 6 months or a shorter time period defined by the PHA, An exception policy might apply a non-enforcement or cure policy to delay only to certain families. This delayed enforcement is only available to families at re-examination. There's no leeway for new applicants. Eligibility criteria for exceptions may provide for separate treatment based on family type and may be based on different factors such as age, disability, income, the ability of the family to find suitable alternative housing, and whether supportive services are being provided. These policies must conform to all fair housing statutes and regulations.
A family cannot receive benefits if they own real property that is suitable for occupancy by the family as a residence. For the property restriction to apply, the family must have a present ownership interest in, a legal right to reside in, and the effective legal authority to sell based on the laws where the property is located. There are exemptions. The PHA may accept self-certification that the family does not have any present ownership interest in any real property. PHAs will also need to determine other elements of the restriction, like whether the family has a legal right to reside at the property and the effective legal authority to sell.
The following exceptions apply. A family that receives assistance for the property from the Housing Choice Voucher Program, including a manufactured home or the homeownership option, property jointly owned with someone else and occupied by the other owner who is not a member of the household receiving benefits, a victim of domestic violence, dating violence, sexual assault, or stalking, or a family that is offering the property for sale.
A family that owns a property may show that it is not suitable for occupancy if it does not meet the disability-related needs for all family members. This may include physical accessibility requirements, a disability-related need for additional bedrooms, or proximity to accessible transportation. If it is not sufficient size for the family, if it is located so as to be a hardship for the family. For example, if the location would be a hardship for the family's commute to work or school. If the property is unsafe because of its physical condition, unless the issue can be easily remedied. Or if it is not a property that a family may reside in under local or state laws. For example, a storefront zoned for commercial use only.
If the family declares a property and asks for an exemption based on because a family member is a victim of domestic violence, dating violence, sexual assault, or stalking, the PHA must accept self-certification from the victim. The PHA must comply with confidentiality rules and restrictions on document requests under 24 CFR 5.2007. HUD will update VAWA-related forms, the forms 5380 and 5382.
Let's do a quick knowledge check related to property ownership. You can put your answer anonymously through the Zoom poll, which we'll launch in a moment, or you can just keep it in mind. Keep in mind that multiple answers are possible for this question. A family is going through a re-examination and reveals that one of the members of the family recently inherited a house. Which of the following, if true, could allow the family to continue to receive assistance? A, the inheritance was shared with a cousin who is not in the assisted family and currently lives in the house. B, the house is valued for under $100,000. C, the house is in another state and moving would cause the family to lose their jobs. Or D, the house is ugly and requires some minor repairs.
So the correct answers are A and C, which did get the most votes. Let's go through the answers. So answer A stated that the family could continue to receive assistance if the inheritance was shared with a cousin who's not in the assisted family and currently lives in the house. This is correct. There is a joint ownership. If there is joint ownership and the other owner, not in the assisted household, lives in the house, it is exempt. I saw answer B also got a lot of answers, and that stated, or got a lot of votes, and that answer stated that if the house is valued at under $100,000, it's exempt. This is not correct, since the value of the house does not matter for the purposes of the real property ownership restriction, which is a separate restriction from the net family asset restriction. Answer C stated that the house is in another state and moving would cause a family member to lose their jobs. This is correct. This could be a reason to exempt the property since losing work is a hardship the PHA could recognize as an exemption. And finally, answer D said that the house is ugly and requires some minor repairs. And most people got this right. That's not true. That's not an exemption. The need for minor repairs does not make the house unsuitable for occupancy, and neither does anyone's opinion of its style.
We'll now move on to calculation of income. The PHA must calculate family income as follows. For new admissions and interim reexaminations, the PHA must estimate the family income for the upcoming 12-month period. For annual reexaminations, the PHA must determine the family income for the previous 12 months, except when using a streamlined income determination. Then the PHA must take into account any redetermination from an interim reexamination during that period. Finally, the PHA must make adjustments to reflect current income if there was an unaccounted for income change during that period.
HOTMA provides for a safe harbor for PHAs who determine a family's pre-deduction income based on income determinations made within the previous 12 months by another means-tested federal public assistance program. Programs that may be used include temporary assistance for needy families, TANF, Medicaid assistance, the Supplemental Nutrition Assistance Program, SNAP, or food stamps, the Earned Income Tax Credit, EITC, the Low Income Housing Tax Credit, LIHTC, the Special Supplemental Nutrition Program for Women, Infants, and Children, WIC, Supplemental Security Income, SSI, or other programs administered by the HUD Secretary or which HUD has established, with which HUD has established a memorandum of understanding, or other federal means-tested benefits announced through a federal registered notice. PHAs may identify additional data sharing opportunities at the state and local level, and PHAs are allowed but not required to use this safe harbor.
Safe harbor verifications. The PHA must obtain safe harbor verifications using the appropriate third-party verification. The verification must indicate the family size, composition, and annual income, and be within the appropriate timeframe. Verifications may come from established data sharing agreements, directly from program administrators, or third-party documentation of a determination provided by the family. If the PHA cannot obtain the verification, or if the family disputes the determination, the PHA must use another method.
Authorization for the release of information. HUD will issue a new version of Form HUD 9886, Authorization for the Release of Information, to be used for reexaminations effective on or after January 1st, 2024. After implementation, once an applicant or participant has signed and submitted the form, they will not need to sign and submit subsequent consent forms, except when anyone 18 years or older becomes a member of the family, when a member of the family turns 18 years old, or as required by HUD or the PHA in administrative instructions.
Access to financial records. PHAs have the discretion to determine whether applicants or recipients are ineligible for benefits if they or their family members revoke the authorization to obtain financial records. Families are still required to provide consent to obtain financial records at the next reexamination. The PHA may establish a policy that revocation of consent to access financial records will result in termination of assistance.
De minimis errors. An error in calculating income is considered a de minimis error when the PHA's determination of family income varies from the correct income determination by no more than $30 in monthly adjusted income. The PHA will not be considered out of compliance due solely to de minimis errors in calculating family income. However, the PHA must correct errors once becoming aware of them. If the family has been overcharged, the PHA must credit or repay a family. Families are not required to repay the PHA in instances where they were undercharged.
Interim reexaminations. A family may request an interim reexamination because of family income or composition changes since the last examination. The PHA must conduct any interim reexamination within a reasonable time after the family request or when the PHA becomes aware of a change. Reasonable processing time may vary based on the amount of time it takes to verify information, but generally no more than 30 days after the family reports changes in income to the PHA.
The threshold for reexaminations when there is a decrease in income. The PHA must conduct a full interim reexamination if the family's adjusted income is estimated to have decreased by 10% or more. 10% is the standard threshold. HUD or the PHA may establish a lower threshold for interim reexaminations that is more generous to the family. For example, conducting a reexamination if there is an estimated 5% decrease in income. Taking on the additional administrative burden of processing more requests is at the PHA's discretion. The PHA may not establish an alternative threshold that is less generous to the family than the 10% standard.
The new rule limits when a PHA must conduct an interim reexamination of family income due to changes in income or family composition since the last examination. When there is a decrease in adjusted income, the family must first request an interim reexamination. That's the first step. This decrease may be due to a change in family composition, including the addition of a new member or members to the household. Therefore, families must be instructed to report these changes. Second, the PHA will estimate if the family's adjusted income has potentially decreased by 10% or more in annual adjusted income. If so, the PHA will take the third step to conduct the reexamination. If the PHA estimates that the adjusted income would decrease by less than 10%, the PHA must decline the request or process the reexamination if the PHA has established a lower standard for interim reexaminations. The PHA must either decline or process the request based on a certain percentage decrease. The PHA cannot decide on a case-by-case basis.
The threshold for reexaminations when there is an increase in income. PHAs must conduct a full interim reexamination of family income anytime the family's adjusted income is estimated to have increased by 10% or more. The PHA may not consider earned income in estimating whether the adjusted income has increased, unless, based on the PHA's written policy, the family received an interim reduction during the same certification period. The PHA may choose not to conduct an interim reexamination for an increase in the last 3 months of a certification period before the regular reexamination.
PHAs can download a simple income estimation tool, or IET, as a PDF from the HUD Exchange. The IET can be used to quickly help families determine if a full interim reexamination is required.
To use the IET, at an examination or when a family reports a change in income, the PHA will enter the family's adjusted income and show the family the minimum amount by which adjusted annual income would need to change to necessitate an interim reexamination. The PHA should be clear that this is an annual change in income, so a one-time or short-term adjustment may not affect their income by the threshold, and also that there are many factors, including family composition, that go into determination of the adjusted income. In this case, the family would be advised that if their annual income increases by 10%, $2,130 or more, they would need to visit the office. As needed, the PHA can explain that earned income will not be taken into consideration. This will likely be best done in person to ensure that the families err on the side of reporting income changes to the PHA. In this case, the PHA is using the default threshold of 10% for interim reexaminations based on a decrease in income. So, the family will be advised to speak with the PHA if their annual income decreases by $2,130. Please note that if the PHA has a written policy with a lower threshold than the default 10% for decreases in income, you can change the percentage in the income estimation tool, for example, from 10% to 8%, if the PHA has that policy.
Applying interim rent decreases when there's timely reporting. If a family reports an income and composition change in a timely manner, according to the PHA's policies, the rent decrease will be effective on the first day of the month after the event. For example, if a family member loses their job on October 12th and then reports the income loss immediately, their rent decrease would go into effect on November 1st.
Applying interim rent decreases when there's delayed reporting. If a family does not make a timely report or the PHA finds out about an income decrease on its own, the rent decrease will be effective beginning the first rent period following the completion of the reexamination. So, using the last example, if a family member loses their job on October 12th, but does not report the income loss until December 10th, the rent decrease would begin January 1st instead of November 1st. However, the PHA may have a policy that allows for a retroactive decrease to the first of the month following the event. The decrease may not be retroactive to a date before the last examination. In other words, a family's failure to report the change at a previous reexamination may not be taken into consideration in applying the effective date of the interim reexamination. So if the same family had an annual reexamination on November 1st and didn't report the decrease until December 10th, the earliest the rent decrease could begin, even with the exception, is December 1st. The policy may be conditioned upon certain circumstances. For example, if a family could not report due to extenuating circumstances such as a natural disaster, any retroactive adjustment must be clearly communicated so that the tenant is clear on the rent going forward.
Applying interim rent increases. If the family complies with the reporting requirements, the PHA must provide 30 days notice of any rent increase, and the increase will be effective the first month following this period. If the family does not comply with the interim reporting requirements, the PHA must initiate an interim reexamination and implement any rent increase retroactive to the first month following the date of the action or event that increased the family's income.
So let's now do a knowledge check related to interim reexaminations. Again, you can put your answer anonymously in the poll that will pop up or just write it down. If a family member reports that they received a raise at work, the PHA estimates that their income has increased by more than 10%. The PHA learns that there have not been any changes to family composition or any new possible deductions. The resident has not had an interim reexamination that year. Should the PHA A, conduct a full interim reexamination, B, explain to the resident that an interim reexamination is not required, C, begin the process of notifying the resident that their rent will increase, or D, none of the above?
So the actual answer is B. The PHA must explain to the resident that an interim reexamination is not required. That's because PHAs may not consider earned income in estimating whether the adjusted income has increased, except when the family has previously received an interim reduction during the same certification period, and the PHA has established such a written policy. In this case, there was not a previous interim reexamination that year, so the earned income increase would not be considered at this time.
Income reexamination policies. The PHA must adopt policies consistent with the rule detailing when and under what conditions the family must report a change in family income or composition. Any interim reexamination conducted under this final rule may not be applied retroactively to before the effective date of the final rule. HUD plans to issue additional guidance on retroactively applying interim reexaminations.
Okay, so now it is time for your questions. You all have been putting questions in the Q&A. The moderators have been looking at those questions and in some cases replying in real time. So they're going to go ahead and read out or explain further the answers from some of the more popular questions. If we can't get to your questions during the time that we have today, you can email them to hotmaquestions@hud.gov. We're also capturing all of the questions that are submitted through both the Q&A and the chat so that further information can be provided. So I'll go ahead and turn it over to the HUD staff.
All right. Hi, I'm Ashley Matthews. I'm from the Office of Public Housing and Voucher Programs. We've seen a lot of questions come in. We've answered 54 questions, so you can review that. I'm going to go over some of them. I do hear from a lot of people that, what you guys are hearing is very complicated, and, these are difficult topics, and, making any changes to the way PHAs operate programs is very difficult to do. And we understand that. And I just want everybody to be reassured that this is, the first training. These trainings are the first two trainings on 102 and 104 are going over, the final rule, the regulations. We have implementation guidance that's coming out this summer that's going to get into these topics in more detail and answer a lot of the questions that are coming up. We are also working on a list of discretionary policies. I saw a question about, do we need to update our admin plan? Yes, PHAs are going to need to be updating their admin plans and their ACOPs to reflect HOTMA policies. There are a lot of areas where you have discretion, like with the interims, where we just we're talking about. And that list, we're going to HUD is working on a list of those areas where you need to make a decision on how, what your policy is going to be, to sort of be a cheat sheet to help PHAs in making those decisions and getting their policies ready to go out for public comment. Let me look a little bit at the questions that we've answered. So we've heard from a few different folks on, do I need to change my interim policy? My interim policy now is to not process increases. Yes, unfortunately, you do have to change that. HOTMA requires that that you process an interim if it's over 10%. There's of course the exception of if it's based on earned income, then you wouldn't process it unless there was a previous decrease. As a PHA, though, you can set a policy to say, we're actually not going to process any earned income increases, even if they are preceded by a decrease. We had a similar question about, we only process increases that are 20% of adjusted income or not. Well, HOTMA requires that, increases are processed if they're 10% or more. So you'd have to adjust that and use the 10% threshold. Let me see. We received a couple of questions about whether or not the requirements apply to small PHAs. I think folks that are asking those questions may be thinking about Section 103 about over income and public housing. The provisions in 102 and 104 that we covered today and last week on the previous webinar, those apply to all PHAs regardless of size. So just want to make that clear that these HOTMA changes apply to all PHAs, all programs. And we did receive quite a few questions on the asset limitation. I'm going to open it up to my colleague, Dan Threet, to talk a little bit about some of those questions.
Thanks, Ashley. This is Dan Threet in the Public Housing Management and Occupancy Division. We did receive quite a number of questions about the asset limitation, and I just wanted to share answers to a couple of the most commonly put ones. So maybe first and foremost, an anonymous attendee asks, how will HOTMA affect those in the program that own real property that is suitable for occupancy? Would they be terminated from the program come January 1, 2024? And this question could also be applied to those who have net family assets in excess of $100,000. So families who are currently program participants will not be found to be out of compliance with the asset limitation, either the $100,000 mark or the real property component, until the first income examination completed after the HOTMA effective date. There is no requirement to immediately conduct an income reexamination of all families after HOTMA becomes effective. When a family is found to be out of compliance with the asset limitation, PHAs must initiate termination of the family, or allow the family to come into compliance according to the PHA's policy within 6 months of the effective date of an annual or interim reexamination. So in short, those families do not need to be terminated from the program come January 1, 2024. Another question that was put was about families who are over the asset limitation, who have more than $100,000 in net family assets, and dispose of some of those assets for less than fair market value, for example, by giving away some of those assets. So someone asks, how about the disposed asset? Now is required to count for 2 years, while the total household asset is over $100,000, so couldn't admit and continue for assistance. And in determining the value of net family assets, it is true that PHAs must include the value of any business or family assets disposed of by an applicant or tenant for less than fair market value during the 2 years preceding the date of application for the program or the reexamination as applicable, in excess of the consideration received for that asset. That said, families may lower total net family assets by other means than by disposing of assets for less than fair market value. For example, they could purchase items that are excluded from the calculation of net family assets, such as necessary personal property, or by moving funds into assets that are excluded from net family assets itself. We received several questions along the theme of whether the asset limitation is required. So one anonymous attendee asks, are we required to terminate households with assets over $100,000? PHAs, unfortunately, do not have discretion to choose not to enforce the asset limitation indefinitely. PHAs must initiate termination of the family or allow the family to come into compliance according to PHA policy within 6 months of the effective date of an annual or interim reexamination if the family has net family assets that exceed $100,000 as adjusted for inflation. And as Ashley mentioned, we will have forthcoming guidance on the implementation of 102 and 104 that will have further details on the structure of non-enforcement and exception policies that PHAs will have the discretion to adopt. Along those lines, another question was, if an elderly resident is selling their home, are they still eligible for assistance? And there are a couple of things that we could unpack in that question, but just say along the lines of the asset limitation. One, there are a series of exemptions to the real property component of the asset limitation. And one of those exemptions is any property that the family is offering for sale. It's worth noting, however, that being exempted from the real property component of the asset limitation does not thereby exclude the real property from the calculation of the value of net family assets. For example, for determining whether the family's net family assets exceed $100,000. So it's not a simple answer to say that they are obviously or not obviously eligible for assistance, but if a family is offering their home for sale, that can qualify it for one of the exemptions to the real property component of the asset limitation. Ashley, I'll pass it back over to you for other questions that you may want to discuss.
Great, thank you, Dan. All right, so I'm going through some more questions. Let's see. We had a question about if a household has $70,000 worth of non-necessary personal property, do you include all $70,000 as an asset or just the $20,000 that's in excess of $50,000? So the answer to that is all of the 70,000. Sorry, 70,000 would be included in net family assets. We received a number of questions about income calculation, and we know that it's a bit confusing with annual reexaminations looking at the previous 12 months, whereas new admissions and interims are looking at anticipated income. We are working on getting you good guidance on that, that provides a lot of examples and helps folks really understand how to implement that. We understand it's confusing, and we just unfortunately can't clarify that very, very much until we get the full guidance out. So please stay tuned for that, and we hope to have that out by the end of June is our goal. Let me see. We received some questions about CDBG and home, other CPD, Office of Community Planning and Development programs. They will have separate guidance coming out. We've really geared this program to the Housing Choice Voucher, not program, but this training to the Housing Choice Voucher and public housing programs. So CPD, we've put it in the question responses. I think it's CPD_HOTMA at HUD.gov if you have questions about CPD in particular. Let's see. And we have received some questions about whether or not for the self-certifying assets under $50,000. The rule does say that you have to fully verify assets under $50,000 every 3 years. You could still accept the self-certification at new admission and annual, as long as you verify them every 3 years. It doesn't have to be at new admission that you do the full verification. You could accept a self-certification of assets at new admission. So just to clarify that, I know that that's a little bit confusing as well. Will there be a specific training for PBRA RAD agencies? So the Office of Multifamily, we have them here with us. They've been answering some questions. They are planning their own trainings with a technical assistance provider. So you'll stay tuned. You'll hear more about specific training for PBRA and the other multifamily housing programs. I got a question about minimum rent and how that is impacted. HOTMA doesn't change the minimum rent provisions, so that is not impacted. Just going through, making sure that I haven't missed anything. And I believe everybody should be able to see the questions that we've answered, the answers that we've provided. You can scroll through and take a look at those. We've received a lot of questions about whether or not we will have an FAQ, publish an FAQ with all these questions. We, as you all probably know, we have an email box, hotmaquestions@hud.gov. We are putting together the questions and answers that we've provided through there, ones that we provided through here, to publish an FAQ on the website so that everybody can benefit from everyone else's questions. We received a question about whether or not HOTMA applies to mainstream vouchers, and it does. So it applies, to all types of housing choice vouchers. It's really changing those, baseline policies that we use for any participants in the voucher program. Okay. We've received some questions about EIV. And again, EIV is a topic that we are planning to cover in our supplemental guidance. Some updates to, what's required based on the new regulations, sort of what makes sense. You may have seen in the final rule that we have some language in there about not needing to use EIV at interim reexamination. So, we will elaborate on that again in our guidance and sort of what that means, and what other changes there may be to how PHAs use EIV. Seen a lot of asset limitation questions that I know Dan has already covered. And so again, I just want to, to say that we understand this stuff is complicated, particularly the topics today, asset limitation, the changes to interims. Those are all really complicated topics. We understand that, we've been working on this guidance for a long time now, and we understand that sort of like when you drill down to, thinking sort of how all this plays out on the ground for you guys and every day, that, there's even more questions that come up. And so we're trying our best to, and it's really helpful to see the questions that you guys have put in to make sure that we cover as much as possible in our guidance. Just want everybody to know that we're planning more trainings on these specific topics to kind of drill down and cover those in more detail, because we know there's a lot more here to unpack and to understand. So thank you so much for attending today. I'm going to pass it back to Farah and Phil.
Yeah, thanks, Ashley. Before we end, we just want to remind everybody that you can go to the HUD Exchange, HOTMA Income and Assets Training Series web pages, and there you will find related resources for all of the trainings, including eventually recordings of each of the live trainings, the slide decks, and the transcripts. The slide deck should already be up, and other related materials should already be up. For Section 103, over income limits for public housing families, in addition to the training itself, you'll find the Section 103 over income limits for public housing families fact sheet, sample over income notices, and a sample non-public housing over income lease.
Sections 102 and 104 for Income and Assets Part 1, you'll find the training, slides, and transcript. You'll also find the Income and Assets fact sheet, Income and Exclusions resource sheet, Student Financial Assistance resource sheet, and the Hardship Exemptions resource sheet. These are all currently on the HUD Exchange. The recording is not yet on the Exchange. Also, I see questions about getting credit. The credit has not yet been processed, but will be.
And then finally, for this training, in addition to the training resources, you will find the Interim Income Reexaminations resource sheet, the Assets, Asset Exclusions, and Limitation on Assets resource sheet, and the Income Estimation tool. All registered participants for the live training will receive a follow-up email with a link to these resources, and it may already have been in the email that you received after registration.
Yeah, and we'll go ahead and send that email again. One for this training and for Part 1 are on the HUD Exchange, so then you'll know to go ahead and look for them. But you can go ahead and review the slides today. So thank you everyone for participating. Thank you for sending in your questions. We have captured them all. If you have additional questions or questions about specific residents, you can send any follow-up questions to hotmaquestions@hud.gov. And this concludes this training. Thank you, everybody.